Hello, listener. Welcome. This is going to be episode 1 with Rob Beardsley for the Between the Sheets series, a mini series. We're going to just, like I said on episode 0, explaining some of the fundamentals of underwriting and actually getting into how you accomplish those fundamentals. So taking theory and actually applying it. Rob, welcome again. Today, Rob, like we talked about, going to be talking about kind of GP structures, so general partner structures. Basically, why we structure a deal the way we do on the GP side. Kind of get into basically why it is incentivized for us and how that actually helps a limited partner in the deal feel more comfortable with it. We'll get into the pros and cons of different types of structures and all that kind of good stuff. So with it, Rob, I'm just going to let you kind of get into it. So maybe just start out explaining what exactly, I guess, a typical deal would be for your team, the Lone Star team, and then we'll talk about the pros and cons and go from there.
Sure. Yeah. So thanks for having me on the show. So the most fairway, run-of-the-mill type of structure would be one that has an acquisition fee, typically 1% to 2% of the purchase price. Lately, however, I'm seeing more deals being put out in the market with an acquisition fee being charged based on the total capitalization of the deal. It's just another way sponsors are able to get more fees from their investors. And we're seeing that a lot more late cycle as investors are demanding more deals and sponsors are in turn, have more leverage in the situation. So 1% to 2% of purchase price or total capitalization, an ongoing asset management fee, 1% to 2% of effective gross income. Some other types of deals may have an asset management fee based on amount invested. So rather than based on the actual revenue produced, it's based on the amount of invested capital. And the other compensation would be a waterfall or a promote split. And so this is a performance-based compensation, typically subordinated to a preferred return hurdle given to the investors. So for example, most commonly what we use is an 8% preferred return, whereby our investors are owed an 8% compounding return prior to us being able to get any of the ongoing profits or profit upon sale. So that would be the most typical. And then on top of that, you see disposition fees. So maybe 1% of the sale price owed to the GP upon sale. Also a loan guarantee fee. So this could almost be considered a hidden fee because it may not be really as advertised or disclosed, but a lot of sponsors kind of sneak that in and just kind of say, oh yeah, well, we're paying 1% to the bank, and oh, by the way, you're paying 1% to me. But it's not necessarily a big acquisition fee that they'll point out. So, I mean, it's crazy some of the stuff we've seen, deals where when you total up all the fees paid at closing, it could add up to really 4% of the purchase price if you're going heavy on the acquisition fee and doing it based on total capitalization, and you've got a hidden loan guarantee fee. So it's pretty crazy. And so I think it's really important for GPs and LPs to really have a good grasp of the structure of a deal and understand the implications of it in terms of alignment of interests.
Yeah, and absolutely. That's why we're here. We're trying to get everybody, whether you're on the GP or LP side, to really understand kind of what you're doing when you're actually underwriting these deals. So with that was a great summary, Rob. I think it was, really from day one to, selling or refinancing, all the fees that you could kind of encounter on the GP side and that the LP would experience. So I guess let's start with the first one there, the acquisition fee. You kind of mentioned how some people are starting to change the way they model these fees. So I guess let's get into maybe the traditional method and then why the logic is, like you explained a little bit, why it is changing for some general partners and the reasons behind that.
Yeah, so it's not unrealistic to be able to say, hey, we should get an acquisition fee based on the total capitalization of the deal. Because, for example, let's say you're buying a deal for nothing, a dirt cheap deal because it's, a real value add, high vacancy, it has a lot of construction costs. For example, let's say you're buying a deal that's $5 million but your budget to renovate it is $3 million. So it's really a, complete turnaround reposition play. The sponsor might say, well, hey, really, we're going to buy this deal for $5 million, put $3 million into it. It's going to be worth $12 million when we're done. Why am I only getting an acquisition fee of, let's say, 2% of $5 million, which would be $100,000, right? Based on actually a deal that's really twice the size of the purchase price. So I think there's something to be said for that. but it's typically not been the norm. And I think it just shows that some people are really pushing to get as much fees out of deals as possible. But if you look at this typical structure with purchase price being the acquisition fee being based on the purchase price, it really doesn't incentivize the sponsor to buy a value add deal. It incentivizes the sponsor to pay more for the deal, so they get a bigger fee, not a huge difference, but rather than buying the deal for less and spending more money on capital expenditures to improve the value, why don't I just buy a deal that's fully valued already and collect a nice acquisition fee based on that value? So I think that is just one of the ways that I'm kind of claiming to say alignment of interests in GP and LP structures are broken. And I think we could talk more about other ways that these alignment of interests are effectively broken.
Yeah, I mean, I think that's awesome. Kind of aligning interests is pretty much the key for all of these fees. They should pretty much you should want to pay your sponsor, right? Because that's going to incentivize them to implement the business plan in a proper way and actually get you more money in the long run. So there is a lot to be said about incentivizing them, but at the same time, you don't want to basically just be writing them checks too early before they're accomplishing anything. So like you said about, having the acquisition price be versus the capitalization versus the purchase price is, an interesting conversation. And I guess it's a conversation that the sponsors have to have with their limited partners. So I guess with these alignment of interest, let's get into the next fee here. So
and before we move on,
sure, go ahead.
You got to keep me honest because we didn't explain what total capitalization is.
Yeah, let's do it. Yeah, let's rewind for just a second.
To recap, total capitalization would be all your costs rolled up at closing. So that'd be your purchase price, your CapEx budget, your closing costs, your legal fees, your lender fees. So a sponsor can take all of those things and roll that up into a total capitalization and say, I want 2% of that, which could be, quite a bit larger than purchase price depending on the business plan. So just keep me honest as we go through things. So,
sure.
So I actually recently read a good article by Ian Ippolito, founder of the Real Estate Crowdfunding Review. So he claims to be one of those really wise passive investors out there. He heavily scrutinizes sponsors, heavily scrutinizes deals. He's a bit too conservative for my taste. He doesn't really like value add and things like that, but he's still a really smart guy. He claims to look at 100 deals per month. That's sponsored deals pitched to him by GPs. So he knows what's in the market and what's going on. And so I recently read an article about alignment of interests, and he was talking about some of these things that we're getting into about whether a preferred return is actually good or bad for the limited partner. And so, just to spoil it, a preferred return is great for a limited partner because of just simply what it does to the economics of the deal. If you look at, let's say, an 8% preferred return, and to be dramatic here, I'll say a 50-50 split, because typically in the market, you'll see anywhere from an 80-20 or a 70-50.
So here's this honesty again, Rob. What's the 50-50 you mean?
Yeah. So after the 8% preferred return in our hypothetical scenario is hit, so 8% distribution is sent out to the investors. Thereafter, the cash flows produced by the property thereafter that 8% would be split 50% to the GP, 50% to the LP. That would be considered very rich, and more market would be a 70-30 or an 80-20. But I'll just be dramatic and use a 50-50. Right, so an investor might say 50-50, that's really expensive. But if you subordinate that to an 8 pref, and let's say the property produces a 10% project level cash flow, the first 8 will go to the investor. Now we've got 2% surplus that can be divvied up, like we said, 50-50. So in the end, investors will take home 9% and the GP will get 1% of the cash flows. However, so sponsors might say, you know what? This 8% preferred return doesn't align interests because it just pushes us to want to produce higher returns, take more risk, take on more debt. So instead, what we're doing is we'll have no preferred return, but instead of the 50-50, we'll do 80-20. An investor might say 80-20, well, that's much better, right? That sounds much more fair. But there's no more preferred return. So if you look at it, property is producing 10% cash flow in our scenario again. With no preferred return, that 80-20, the investor takes home 8, and then GP gets 2. So investors actually got 1% less than in the 50-50 scenario. So, and also that preferred return offers protection, because if the property doesn't perform on pro forma at 10% and only hits 8, 7, 6, investors will take it all rather than splitting 6, 80-20. So, at the end of the day, there's a lot of story and marketing behind a certain GP structure that sponsors may be pitching, and I think it's really important at the end of the day, plug it into the model and see, how does this truly affect my economics, my IRR, and my risk-adjusted return? And similarly, if you're a GP, I think for us, it's important to stand your ground, charge the fees that you think you're worth, but try to do as much as you can to not have investors say no. Make it easier for them to say yes.
Absolutely. Yeah. So you spoke about a lot of juicy stuff there. First thing that kind of struck my mind is we got pretty heavy into the, sponsor split, and after the preferred return, kind of what happens there. And then you kind of mentioned, risk adjusted based on the deal. So I guess you can kind of speak on for me where those deals, as far as the split after pref goes, and how that relates to a deal where there's a risk-adjusted return. Say there's, basically a light value-add property versus, something where you're kind of getting into the nitty-gritty and really diving in deep with some heavy construction. So, I mean, there has to be some variance there, right? So how do you approach that?
Definitely. So the less the sponsor has to do, the less they should get paid. So... And you'll see, especially in the institutional world, institutional investors are very smart and they are very fee averse. And so I've heard institutional investors, and these are companies that invest as LPs for a living. It's their profession to do so. They'll say, hey, if you're buying the deal and it's on market, we won't pay you an acquisition fee because it's just on market. Anyone could have just bid on that deal.
Right, you didn't do the work, basically.
Yeah, and they'll say, well, if it's truly off market and you're bringing us a unique opportunity, we'll pay you the point. And so that's the narrative on the institutional side. On the retail side, it's much more market to get 1%, 2% acquisition fees. So I think, sorry, let's get on. I'm losing myself.
Yeah. So basically, what I really wanted to kind of get into was you mentioned a deal where you went 50-50 with an 8 pref versus 80-20 without pref, and that was gravy for the sponsor on a deal where they could still achieve that 10% cash on cash every year. Say so. Right. I guess where can that vary as far as the type of deal that you're actually getting into to begin with? So
yeah. Thanks for helping me out.
Sure.
There. So basically, right, we're going along the risk spectrum. The promote should increase, or you could argue that it should increase. So, for example,
and promote is that split, right? So that would be
the
for
promote,
the GP. The promote would be
right. Let's say on the low end, 20%.
Yeah.
Subordinated by an 8% preferred. And so, like you said, if it's a light value add and we're late cycle, and if the property is only projecting to perform at a 7-8% cash on cash over 5 or 10 years, then I've seen 6% preferred returns, and that is okay. It's not unreasonable. And then, if you're taking more risk or a deal that has more, you might want to offer a higher preferred. But I think really the play happens with the promote, with the compensation based, the performance-based compensation. So, for example, I'm seeing a lot of investors have a second hurdle. So let's say upon sale, they're able to hit a 15% IRR. Above that, they'll say, we're going to split the proceeds upon sale 50-50. And I think that is reasonable. I think that's warranted. But unfortunately for investors, what we've seen happen is only just a few years ago, it was 18%. So after an 18% IRR, the profits would be split 50-50. And I mean, if you think about it, depending on the risk of the deal, but if it's just a regular value add, 18% IRR is a home run. That's
absolutely.
A great return.
Yeah, that's just a good buy off day one, basically.
So investors should be happy to give 50-50 above that, right? Because that deal just performed amazingly.
Yeah, minimal risk compared to a heavier deal, and you still got a pretty high return. So yeah.
Exactly. And then, but unfortunately, we've seen that 18 come down to a 15, and now it's a 13. So we're seeing these tier 2 hurdles come down as the returns get tighter, and as GPs get better command with their investors. They feel more confident in their ability to raise capital, and therefore their terms become more onerous. So going back to what you said about risk-adjusted return, hurdles can be a good way, rather than a hurdle where you get further compensation. There are hurdles where I call them an IRR look back, where the GP won't get anything until a certain IRR is hit. It's kind of like a preferred return, but for an IRR. And so we recently did a deal with an institutional investor group, and we actually subordinated our GP behind a 15% IRR. So if you're talking about risk adjusted, they're in the deal, they're going to get great cash flows based on a 9% preferred return. And depending on the profits of sale, they know they're going to the extent that the proceeds are there on a project level, they're going to hit that 15% IRR, and we're not going to make much money at all until we hit that. So I think that is a tremendous alignment of interests, and it really incentivizes us to make sure we go after and achieve that highest total return. But for investors that maybe aren't IRR driven, and these would be longer term cash flow investors, maybe that's not what you want. You probably don't want a sponsor that has in their structure a tier 2 waterfall where after a 15 they get 50-50, because what's the sponsor going to want to do? Sell the deal right away, maximize the IRR, because IRR goes down over time on deals, so it's much harder to achieve a 15 over a 10-year period rather than a 3-year period. So if you're a cash flow investor, you might say, hey, let's just remove that. We want to stay in the deal in cash flow. So you definitely want to not only see how the structure affects your economics, your bottom line profits, but also how it affects the alignments in the deal and what it's going to incentivize the sponsor to do.
Yeah, that's excellent. So just to kind of summarize what Rob's saying, essentially after that 8% or whatever number pref, you have your profit split after that. So 80-20, 70-30, where 70 or 80 would go to the LP and then 20 or 30 would go to the GP. And then that hurdle would be after a certain amount of IRR, which is that basically annualized rate of return. So say all of that, juicy monthly cash flow, and then the sale gets you to say above 15%, that hurdle hits 15%. Now that goes from 80-20 to now 50-50, because basically as a GP or sponsor, we did a pretty good job to be able to say, hey, we basically executed business plan properly. We sold or refinanced whatever the actual business plan was. Now we deserve a little bit more of the pie because we actually were able to accomplish that. So all of what Rob is talking about just now was basically saying that with that type of deal where there is, that hurdle, you also have to consider what type of investors you're working with. So if you had someone that, like you said, was a cash flow investor, they might not want, that zero pref and all hurdle-based incentives, because that's going to, like Rob said, just want them to sell quicker. Instead of the 5-year business plan, which is common in a deal like this, it might be technically a 5-year plan, but the sponsor might want to sell in 2 years to be able to, hit that IRR and, cash out their side of it. So instead of that, if you had a cash flow kind of investor base, you might want to keep that pref in there so that they get that 8% every month, annualized every year, and then they get all the, hurdle above that, so they might get that 30%, getting them up to maybe a 9 or 10, and then at the sale they'll still get that bump. Maybe not as high as what it would have been normally, but it would still be a good cash flowing property that they'll be able to stay in for the 5 years versus something that you might be able to exit out of in 2, and you're going to have to do the whole process over again. So a lot of this that we're talking about today is really just kind of getting into the benefits, pros and cons of all of these types of structures, and why you need to actually know what you as a GP wants in the deal. Do you want that big check at the end of the day, year 5, or do you want something cash flowing from day 1? And then the same thing for the limited partners is, do they want checks in the mail every month, or do they want that bigger check at the end? So all these kind of structures really just kind of basically spread out where the cash flows go. So to be able to know how the numbers affect everything is pretty much why we wanted to get into it today, because every number that you check off in the Excel sheet is going to affect everything. And I guess it's called a waterfall for a reason, right? Because that's pretty much what you're doing here. It's crazy compounding that can happen if you're not doing these properly. So
yeah, and going back to the mechanics of a waterfall and the complications of it, a preferred return isn't a preferred return. It can be many different things. So I've seen, and we've done deals differently where the preferred return was a non-compounding return, and we've done a deal where it was a compounding return. So
I'd love to get into that.
yeah, so in most cases, a pref is going to be accruing. So you don't make a payment. Let's say year one, you don't pay anything. That 8% will carry over to year two, and now the sponsor effectively owes his investors 16%. And it'll just accrue. And then upon sale, the waterfall or the liquidation preference would be first catching up on that preferred return. So let's say we bought a deal and sold it in 3 years and we didn't pay the investors a dime. So upon sale, we'd first have to pay them 3 years of preferred return, call it just 8 plus 8 plus 8, 24%. And then they have a return of capital. So once they've achieved their 24%, a return of capital, only then would the profit split begin of, let's say, a 70-30. So investors above that would get a 70% of the remaining proceeds of the sale, and GP would get 30%. So, but now, what if that preferred return was compounding? So it was accruing, meaning unpaid moved on and accrued over time, but compounding would mean if that 8% wasn't paid in a year, the sponsor would now owe interest on the missed payments. And so basically the 8%, you'd owe 8% on the 8% that you didn't pay. So that's the compounding aspect of it. So that can be painful for a GP and, just even better for the LPs. And so I think, and that's what the institutional investors push for, is that it is accruing and compounding, so that not only is it should be painful to miss a payment, basically. If investors want to see their pref and they don't, it shouldn't just be, oh, okay, well, just pay me later. It should be, all right, you're going to pay me later plus interest. So it's just a further incentive to make those payments. So I think just as you're looking at deals, see what the preferred return actually is, because maybe I don't know, I haven't seen it, but maybe it doesn't even accrue. You don't pay whatever you don't pay, it just disappears. So check to see what the pref looks like. And I've also seen structures where the sponsor will forego or subordinate their asset management fee to the preferred return, which is terrific if that really is the case. However, you have to look at a layer further, because those same sponsors that are offering this great selling point of being able to say, hey, we're not going to collect our asset management fee to keep even the lights on until we pay you that 8% preferred return. That sounds too good to be true, because often it is. And now, because 8% is so hard to hit these days, just think about it. If you're buying a deal at a 5 cap and you're financing it at a 4% interest rate, how are you getting to 8%? That's really tough. So the delta there is typically made up by what people are calling pre-raised distributions or raised capital. And to keep investors feeling good about ongoing payments, an investor or a sponsor will actually raise, let's say, $1 million worth of capital from investors for the sole purpose of then to turn it around and just send out those monthly 8% checks. I mean, it helps with accounting, because basically with all that cash in the bank, all the sponsor has to do is just kick out 8%, and then at the end of the year, analyze and see, well, do we have cash flows in excess of that? Are we able to distribute more? If so, then we distribute it on the promote split. If not, then they got their 8%. And by the way, they got their asset management fee because they paid the prep. So that's not the end of the world, but you have to look at how an investor doing that, because it is quite nice for an investor to invest and get 8% annualized, like you said, every month. That feels really great. Even if they know it's some of their own money, that still feels nice. However, they have to analyze and look, well, that additional pre-raised capital goes to increasing the total cash outlay, which then is just dilutive to the total returns. So because you're seeing your money right back to you in cash flow, your cash flows are higher. However, your total return, your IRR, your proceeds upon sale will be lower because you diluted the equity.
Yeah, I mean, basically you have, so like you say, you're raising a little bit more money, like you said, an example, $1 million. So say the raise was, say, $7 million before, considering this option, and then you raise an extra $1 million. So now you're at $8 million. So yeah, you might have those cash flows to be able to, easily write those checks every month to your investors. But then now you have, basically a 15% decrease in the return, because now you have, instead of, say, $7 million worth of investors, you have $8 million worth of investors. So just right off the bat, now you kind of have, like you said, kind of dissolved that return for everybody just by, a little bit. So there's some consideration that, like you say, a lot of it would have to do with whether you think you could achieve that. And that conversation you should be having with your co-sponsors and your LPs really too is, I guess, do you think that pref is achievable? And if you're kind of stretching that pref a little bit higher, why are you even doing it in the first place? So you really should be kind of agreeing on, based on the deal, what that pref should be. And I mean, a good sponsor shouldn't really be kind of raising just for the sake of raising, but really should be kind of raising, for the deal. It should be always deal specific. So there are obviously certain scenarios where that's, applicable, I think, of course, but you really shouldn't just be, writing checks out of nowhere. You're kind of just moving money around, and that can get into a dangerous little game. So
right. Yeah, exactly. And, I think when I first was exposed to all of this, I thought, wow, these sponsors are evil and they're manipulating their investors. But really, and Ian, in that article that I mentioned from the Real Estate Crowdfunding Review, I thought he was going to tear this apart and say this is the worst thing ever. And because, this guy is very straight and narrow and he's very conservative. But he said he frankly blamed it on investors. He said it's the LP's fault that this is happening because investors are demanding returns that aren't achievable. There's a reason why every deal you look at is an 18% IRR. It's not because they are that, because I promise you they're not. Most deals today are penciling to 12%, but investors demand it. Investors expect it, and they'll turn you down. We've taken deals to market and said, hey, invest with us. Here are our honest returns. And they said, no, the returns are too low. And so we went out and said, all right, well, we'll get a little more aggressive. All right, here's our deal. Here's our returns. And, we got the deal done. So it's partially investors' fault that we still have these 8% preferred returns and that sponsors are underwriting so aggressively when we really should be lowering our prefs and saying, hey, this alignment of interest mechanism isn't broken. We can just lower it to make it more realistic. And that way, if we don't perform based on how we should, this accruing and compounding mechanism of the preferred return actually is there to incentivize us to get back on track. Rather than us just raise it, pay it, we don't have any worries of missing preferred return payments or things like that, or having to have them compound. So I think, that's an unfortunate reality of the market today.
Yeah, and kind of what Rob spoke of quickly was he mentioned the alignment of interest, but with that, and we're talking about these deals, today at least, where they're, slowly lowering in return, is also the alignment of expectations. So like you say, it's almost the limited partner's fault, which, it's everyone's fault in the deal, really, to an extent. But like you say, if you can't get the investors to kind of meet your expectations in a deal, and Rob spoke of a deal where he was showing the true value of a deal at a 12% IRR, say, and investors weren't happy with that because it wasn't an exciting number. 12 is not as exciting as a 15 or 18, obviously. I mean, Rob could be a dishonest person and, really play with the numbers and get that way up there and call it, a great deal home run. And that's, what some people may be doing now. So to call it the LP's fault, like you said, is kind of a little bit with that, where they need to almost, make sure they understand a deal, in its essence, to know the underwriting. So kind of what we're hopefully going to be able to prove to you in this series, but to know the underwriting, to actually know what the deal should realistically accomplish, will kind of align not only the interest, but the expectations. So a lot of that is what we're hoping to accomplish. And then, a lot of this GP talk was awesome. So I think with that is a great time to stop. We're going to now try to cut to the actual nitty-gritty of it. We're going to get into the Excel modeling. We're going to get into Rob's model, really show you how to accomplish these kind of setups with the model, and then we'll play with the numbers a little bit and see how some of these theories that we talked about affect a deal, playing with the IRRs, or playing with the prefs, playing with the promotes, all that type of good stuff, and really kind of see how the same deal can really be affected monumentally throughout all of these kind of decisions that you make. So here we are on the spreadsheet. This is actually Rob's spreadsheet that he uses for every deal he analyzes. This is an example deal. We have some numbers plugged in, and then we have the typical structure as far as all the things we talked about previously, the acquisition fee, the promote, the pref, all that good stuff. So we're going to basically run you through this deal and then play with the numbers and see how everything's kind of affected. So Rob, with that, you want to just kind of walk us through this deal and what we got going on?
Yeah, so these numbers are based on a real live deal that we're pursuing, and you can see the returns are fairly indicative of what is out there in the market for a pretty well cleaned up value add deal that has meat on the bone, but is for the most part a well performing stabilized product. So I think right now you can typically expect anywhere from 13 to 17% project level IRR, which then results to anywhere from 9 to 14 LP IRR, depending on the structure. So here in this particular deal, I mean, we're not so focused on the returns themselves, but just how they're affected by the GP structure. But just to point them out, here we have a summary of the LP returns with an example investment to the right of them. So you can see over a 5-year projected timeline, the cash on cash returns, as well as the profit upon sale. And then, like you mentioned, we're just looking at this deal right now with a very traditional sponsorship structure with a 2% acquisition fee, 2% ongoing asset management fees based on revenue collected, an 8% preferred return, and then a 30% promote, meaning the GP gets 30% of cash flows and profits upon sale subordinate to the 8% preferred return. So jumping back to the summary, you can see for this hypothetical deal, the preferred return is just missed in year 1, and so that'll be caught up in year 2. And so the model factors that in, and it accrues that missed 10 bips over to year 2 and pays that 8 pref, and then also distributes excess based on the waterfall. So let's walk through. So take a mental screenshot of these returns and just see that it's a 10.7% IRR with an 8.5% cash on cash. And then go ahead.
And again, these are just numbers. This is not a real deal or anything. This is just kind of showing just some general numbers. I mean, the 10 is not like this is a good deal, bad deal. We just want to see the changes here. So don't be caught up on, whether this is good or bad. Just, focus on the changes that are happening with these numbers as we kind of fix these structures. So just keep that in mind.
Exactly. Perfect. And then on the GP side, here's what the GP is expected to see from this deal on a 5-year timeline. And I definitely encourage sponsors to look at what are they getting out of a deal and what makes sense for them, because doing a deal just to do a deal doesn't always make sense. Unless you're just a fee-driven model where you're just trying to crank out as many deals as possible, then obviously that's a different story. But if you're actually constrained by the amount of deals you can do per year and you're focused on doing the best, then you should really focus on what you get out of it, and is it aligned with your goals? Maybe you want to sell quickly and make your promote, but your investors want to stay in for 10 years. So modeling this is very helpful for the GP side, not only for the LP side to show what the projected returns are. But anyway, here we have a nice acquisition fee which is market to pretty nice, and then the asset management fees are ongoing here. You see there is no promote earned in year 1 because we just missed the pref. Pref is then caught up in year 2, and then the GP starts earning on this promote here. However, something interesting, you might say, why did it go away in year 4? And this is that pesky interest-only period that expires. Typically, a lot of loans, 10-year loans today, have 3 years of interest-only payments, and then after the 3 years is up, the loan begins amortizing on a 30-year schedule, which is negatively impacting the cash flow. So you see that actually the promote goes away after years 4 and 5 because of that amortization. So let's jump back to the LP summary. You can see we're at 7.9, great for year 1. That's terrific. If you can find a deal with 8% going in, that's wonderful. And we get all the way up to 10, but then we begin to amortize, and now we're down to 7.3. So I think that's something really important to notice. A lot of investors out there on the conservative side, they say interest only is bad. I hate interest only. Interest only investors are aggressive and they're going to blow up their deals. I'll tell you, interest only is a home run. It's a wonderful tool to extract the maximum cash flow and to achieve the best returns. However, that doesn't mean you ignore the consequences of beginning to amortize or what that means to your investment. So here you can see the drop. You might say, going back to the GP, they no longer are earning a promote, so what do they want to do? they want to sell this deal. If it's not going to be earning them a reasonable promote, the incentive isn't really there to continue holding the deal and just paying out that pref. So they would rather sell and achieve this sale promote. So right there is just one interesting point I'll note about this structure and about how this deal we've modeled here with a 3 years interest only. Anything I should point out here?
Well, I was just going to say, and this is semi-common, you'll see, because year one, you might not be able to stabilize the property in time to actually hit that pref, or you maybe just clear it. So that year one cash flow promote that you can see and sell, F18, that $0 is probably pretty typical, unless you have a really home run deal that you have a good opportunity to be able to really turn the property on quickly. So that you can, at least today, is probably a pretty common occurrence. And then Rob spoke about basically year 2 and 3 is where you really start to achieve over that preferred return, which is obviously great. And then, like he said, that interest only period where you're only paying interest on the loan and not paying principal and interest, that is kind of where it drops down in year 4 and 5. And so I guess, like you said, the motivation there, Rob, right, is that now that you're not earning that monthly as a GP on the cash flow promote side, and you're only earning just that, say in this case, $30,000 in asset management fees a year, your incentive on this deal to stay in it is pretty low, right? Because you're doing a lot of work for $30,000 as far as the asset management goes, implementing the business model and making sure everything's running smoothly. That's kind of a lot of work and possibly a big headache for $30,000. So at that point in year 4, like you said, maybe it's time we try to sell this, as long as everything is, good opportunity-wise. So I guess let's maybe play with those numbers and see how we can kind of negate that maybe.
Yeah, let's definitely play around. And since we brought up the asset management fee, I think we should elaborate on it a bit and say, number one, an asset management fee isn't all profit. So if you're a growing sponsor and you're trying to optimize your business, you're likely taking your asset management fees, rolling that into hiring asset managers, and you're spending on software and travel costs. And there's lots of
things. This isn't just a check, basically. Yeah.
Exactly. This isn't just going as it's not just 100% profit. So I think it's important to ask sponsors as an investor, what ongoing cost do you have that you use your asset management fees to pay for? And also, what additional costs are not included in that asset management fee? So often sponsors will charge travel costs to the property on top of their asset management fee. So in our opinion, your asset management fee should be inclusive of those travel costs. So it shouldn't be an additional line item paid by the property. So it's just interesting to ask your sponsor that you're investing with, what does this cover? What does this not cover? And then the other point that we were talking about off camera was investors, depending on their strategy, should maybe want to pay an asset management fee. Because in a minute, we'll model a deal with no asset management fee and say, well, less fees, that's great. But in a recession or in a case where a property goes bad, if an investor isn't getting paid anything ongoing and the deal's tanking and they're subordinate to an 8% accruing pref, they know they're never going to see a dime out of the deal, there's really no incentive for them to stay in it except their reputation. So having at least that asset management fee that is paid to them regardless of performance is just another way to potentially keep a sponsor involved in a deal when it's going really poorly.
Right. That's basically the minimum, keeping them above water to at least, want to stay in it financially from that perspective. Might not be a home run as far as, a deal for them for that year 4, say, but at least, they're covering costs and doing their, diligent work on the property. So yeah, I definitely agree with that.
And I know we're jumping around a bunch, but we'll get to it.
That's all right. We got a screen in front of us, so we can click around and show whatever we want. Hopefully, we're going slow enough not to lose anybody.
So looking at this now, I just wanted to point out.
This is what your pro forma financial. So this is whole summary, basically, year 1 through 10 of the business model, line by line, right? So
correct. Yeah, and I think since we brought up interest-only payments, something really important is a debt service coverage ratio. This is important to lenders. This is important to investors. And a debt service coverage ratio is your net operating income divided by your debt service. And debt service, as defined by everyone, is amortized debt. So you can't calculate your DSCR based on your going in interest-only payments. Because if you do that, you might say, for example, here I've got total ICR, which is interest coverage ratio, so just paying on my interest, I've got a going in 1.8. That's terrific. I'm
Right, you're not paying down the mortgage for the first 3 years. You're only paying the interest. So
right.
yeah, it's almost
So
two times.
by year 2, I'm producing an NOI double my debt service. That is a really safe position to be in, because if the property, an unheard of swing in income would be a 50% reduction, and you still able to cover your debt. That is incredible. However, you're going in DSCR, which is how lenders underwrite deals. Lenders see, okay, what are your going in cash flows based on even though we're offering interest only, if you were able to cover, and they're only typically willing to extend based on a 1.25x coverage ratio. And you see here, based on a T12 metric here, we're coming in at 1.24. So I've modeled this deal actually from a lender's perspective to see, to predict what would a lender truly lend on this deal. And this is important to know if you're a sponsor and even an investor looking at a loan term sheet, and you could say that loan term sheet is or isn't realistic because you've taken the time to actually underwrite it and see if they're going to pass these certain tests. But anyway, as an investor, you might want to see how do they cover on a DSCR basis and on a truly amortized basis, because some people are pitching their deals saying, hey, this deal has great coverage. We're covering at a 1.6, but it's interest only. So that was my quick aside there.
No, that's a good little catch to, be on the lookout for as well. So yeah, knowing the difference between the interest coverage ratio and the debt service coverage ratio is definitely key there too. So yeah, let's jump right back into it, I think, Rob. So I guess, yeah, we'll kind of get back to the front of the deal here, and we'll start to kind of toy with what we talked about, I guess.
Yeah. So what we'll do is we'll just do the basic comparison where here we had a deal with a 2% asset management fee, 8% preferred, and a 30% promote. Pretty fairway. Some people consider it on the little bit more expensive side. And then what we'll do is we'll get creative here. We'll eliminate the asset management fee, and then eliminate the preferred return and just do a 20% promote. So this could be pitched to investors as a much better structure that's simpler and more aligned, and say, hey, look, we're not charging any fees. Let's just be partners, 80-20 in the deal, no preferred return, and let's see how that goes. So let's look at the summary, and we'll see, okay, the IRR was 10.7, now it's 10.3. So that's a slight reduction, because if you think about it, upon sale, the investors are going to do better since they're going to get 80% of the profits upon sale rather than 70. So the IRR is not affected as much. It would be affected more if the return was bigger to begin with, if we were talking about 16 to maybe 15 or 14 even. But if you look, the story is more interesting on the cash on cash side, where now our cash on cash year 1 went all the way down from 7.9 to 7.1. So, and if you look at it, the average went down 7.8, and I forget what it was earlier, but we can kind of go back and forth. But right there, you can see this structure, although could be pitched as more aligning, your economics are poor. So, hey, less fees, but really you get less also.
Right, and when you're doing this type of scenario versus, that traditional that we had set up before, where you had the pref, once you remove that pref, you're kind of foregoing that quote-unquote guaranteed cash flows throughout the business plan, and you're relying heavily more on that year 5 sale or refinance. So unless that refinance is, crazy good, and, you're going to be netting a ton on that, you have to consider the time value of money. So if you're not earning as much years 1 through 4, you're actually going to see, in this case, it was 0.4%, so 40 bips lower on the IRR. So you're going to see that, obviously it's deal dependent, but since you're not earning as much early on, that IRR is affected probably in a negative way, unless, like I said, that sale is crazy high and that 10% that you earned on the promotes. So we went from, a 30 promote to a 20 promote. So now as an investor on the sale, you earn 80% through everything versus the 70% at sale. So unless that sale is huge, you might not see that even be in your benefit. So you really have to consider that too, as far as basically the timeline of the money that you're accruing through this deal in the investment. So,
right. And also you mentioned risk adjusted, I think. Risk adjusted without a pref, dollar for dollar, every decline in cash flow you're hit with, right? If you just get 80% of the cash flows, a dollar decrease is a dollar decrease to your cash flows. However, if you have a pref, you're protected. So the cash flows can go down, but you're still owed that 8%. So, for example, if we stress this deal and let's say, oops, the market went down or we had a recession or we just underwrote incorrectly and the vacancy isn't actually 6, it turns out to be 10%. And, obviously none of this happens in a linear fashion, right? We could have 1 year where it drops down to 15, comes right back up. But when we model, we don't model to be 100% realistic. We just want to be accurate.
Consistent,
yeah. Exactly. So if you look at this, we stress the vacancy up to 10%. IRR is hugely impacted, obviously, because you're selling at a lower valuation and your cash flows are hurt as well. Meanwhile, if I quickly jump back to this structure, the traditional structure, your cash flows are better and your IRR is better. And you have to, and in this scenario, you actually didn't even make up the pref over the 5 years because the average is 7.2. So when you sell, you're actually entitled to making up that pref out of the profits of sale. So before you distribute any profits, you first make that pref whole and then you get your money back and then the profits are split. So in the end, it's hard to argue that a pref is in any way bad for investors. The comment that is often thrown out is that it pushes sponsors to be more risky, take on more debt to increase the cash flow and, pursue deals that have more risk. They can get higher cash flows or things like that.
Or maybe even raise the funds like we talked about earlier too. So
yeah, exactly. And
so on this deal specifically, like Rob just showed, he quickly went from, we went from a 6% to 10% vacancy. And then with that, I think it was 4 and change percent on the LP IRR. So the cell above he has selected there. And now it's a 6.1 with the traditional structure in place again. So basically with that traditional structure, you kind of are protected more. Like you said, it's, pretty much usually typically beneficial to have the pref as an LP investor because you are protected to always get that first. You are the preferred return, so you are getting that first. So instead of that scenario where you're only getting 20% no matter what, you're basically signing on for more risk because you're saying basically, okay, whatever happens in the deal, I'm on board no matter what. Whereas if you're, signing up for a pref, like in this case, you could see it went from 4.7 to 6.1. You're saying, okay, I'm on the deal, but I also want to make sure that I get paid a little bit first, at least, to make sure that I get, some security in my investment. So that's kind of the general sentiment there. Just one more time to hammer it in. I think I mentioned too, Rob, kind of the raising funds to go along with that. So why don't we throw that in the model and see, I guess, how that affects it and why, I guess, we can argue the one con with this whole preferred return is we talked about, overselling or overpromising. So,
right.
If you overpromise, then you have to raise more just to get the pref in general. Let's, I guess, compare it from the base model and then add in, some arbitrary additional raise and see what that looks like.
And I just had an epiphany with you talking about this just now. If you raise more dollars to pay pref, it dilutes the LP's return because let's say upon sale of a deal, there's $1 million profit, right? But that profit of $1 million could be achieved with, let's say, $4 million of equity, but let's say the cash flows are terrible. And so the sponsor chose to raise additional to make up the pref. And to be round numbers here, he took it up to $5 million. That $1 million of profit could have been spread around $4 million of investors, but now has to be spread over $5 million. So like we mentioned before when we were just talking in front of the camera, that's a dilutive to total returns there. However, the crazy thing that I just realized now is that doesn't affect the GP's take of the profits upon sale at all. If you think about it.
Right. There's no risk to the GP to do that. The only risk is kind of not accomplishing the project. And that would be the risk is to their name more or less, but not really the deal in and of itself.
Right. The $1 million of profit, if they're, let's say, getting 30% of it, they're going to make that $300,000 regardless if it's the LPs are sharing the 70% amongst $1 million of equity, 2 million, 3 million, 5 million. So that is an interesting insight that I just had now. So it doesn't hurt the GP. It doesn't dilute the GP's returns by raising, but it does hurt the LPs. But it does make them happier in the meantime. So as an investor, if you're a cash flow investor, you may just want to weigh the pros and cons there. But like you said, let's jump into a scenario where, here and we're going to kind of stray away from, real life underwriting, and we're just going to model the deal so it's best to exemplify what we're trying to show. So what I'll do here is I'll make the terminal cap rate 5.5, which is unrealistic in my opinion for this deal, but it puts a higher IRR on the project, which allows us to manipulate it and actually see the variances easier. So
so Rob just wants to basically sell it. Doing that cap rate, making it a little bit lower means basically we're just going to sell this property higher. We're not going to get into that today. We'll get into that in another episode, but basically by lowering that cap rate, you're selling it higher. So our IRR you just saw jumped up to 13. So he just did that just so we can see kind of more deltas, more differences in the returns basically. So instead of going from, 4.5 to 4.7, we're going to go, from 13 to 10 or something like that. Just so you can see the numbers a little better basically.
Yeah, perfect. Exactly. So, and then to be further illustrative, I want to, how do we do this? Let's raise the purchase price. Basically, I want to show a deal.
Big numbers. Let's get into it.
I want to show a deal with being purchased at a lower cap rate, which in turn has lower cash flows. So this works for me. So here on average, we have 6.2% cash flows. So we know that there's a shortfall in the pref, right? So
yeah, that's perfect.
we need money here. So what we'll do is I'll just do some quick math here, and I will unlock the spreadsheet really quickly, and I'll just input what the pref is. So what we'll do is we'll say, here's capital invested times 8%, right? Here's our pref. So, and I'm just a neat freak, so I'm just going to format and get all that going. So as you can see, here's our delta between free cash flow and then the preferred. So what I'll do here, and I should have just prepared this beforehand, but it's okay. So I will take this and just apply this to years 1 through 5. And then here for our benefit, I will put what the shortfall is. Oops. So there's a shortfall.
So basically, years 1 through 5, we're kind of showing the shortcomings of what we actually, accomplish for the property versus what we promise for the preferred return. So that number that he just made in the cell on row 53 is what the 8% preferred return would be. And you can see on the more highlighted cell on row 50, it's obviously not achieving that pretty much every single time. So that last column there on, or the last row there on 62 that he's drawn up right now is basically saying that's the difference that we basically are going to just go through a scenario where we talked about earlier, raising that money. So yeah, that total $323,000, we got to raise that money to kind of dilute the shares, but then at the same time, we'll be able to hit that preferred return, and everybody will be quote unquote happier with that is what sometimes you're seeing nowadays. So we're just going to go through that scenario.
Yeah, and if anyone was watching me and I did a summation calculation and it came with the wrong number, that's because I have a lot of hidden columns here. So I have to manually add. So That's no big deal, but exactly right. So our sum shortfall to make the pref payments is $323,000. So what first we'll do is we will just do reverse expenses equal to the shortfall, which then allows the investors, I see, not too happy about that. Let's see, how does that work? Okay, so we can't do it that way.
You can just copy and paste the value, basically.
Yeah,
That's
exactly.
what I would do.
So I will just...
We're flying right off the cuff here, folks. We're just, getting into the spreadsheet, figuring out how to show you illustratively the best way to do it.
So there we go. And then now the cash flow jumped to 8. So boom, we made it. And then we're going to take it again and just get all of the cash flows via this pre-raised distributions, and then go like this.
So by raising that $323,000, we achieved, raising that shortcoming. So now we can take that money, like we said on the more video portion of this, and basically just take that out of the, checking account, whatever, and write those checks, even though we technically don't have the money to accomplish that because of the property. And now Rob is adding basically, that extra amount that we're going to have to do. And we'll show you adding that $323,000 now that we have that 8% pref, sure, but adding that $323,000 raised to the total amount of capital raised, how that kind of dilutes all of the shares and all that good stuff. So yeah, we're back on that page.
Yeah. So thank you for that explanation. So just to recap, money doesn't come from nowhere, right? We had
Exactly,
to get it from somewhere.
So new investors, we raised 323 again.
Right. And I just put it in my interest reserve input, but basically all that does is it increases the total cash outlay. So here, this number is incrementally larger by 323,000. Everything else is held constant. It doesn't affect our debt or any other assumptions. And if you look, we should be at 8% along the way. What happened to us? Oh, you know what happened?
Might be some funky math with the circular.
It's a circular error.
Okay, so you know what?
But hang on.
Yeah.
So basically what happened here is because we raised more, the pref increased, and now those payments that we made that should have made the pref 8%, we are short again. So
Right.
in effect, I mean, if we're doing this, we might as well do it all the way and get as accurate as possible.
Divide that by 0.92, I think, to get it right.
So I think what we'll do is we'll take these and we'll just, so it looks to me like 26,000 a year. I think we just need to do minus 26,000 and then we'll be back at 8%.
Yeah, we're basically reaching a limit if you want to get into the calculus of it, but we'll get you there, folks. Yeah, we're basically trying to show you that getting to our 8% pref like we advertised is going to allow you to do that, but to do that, the con of it will be to dilute those shares, and then so we're trying to basically get that inputs or that summary sheet to show 8% through years 1 through 5, so that everybody's quote unquote happy with that. But then show the general summary of returns. So yeah, the cash outlay is 8% every year, but then your summary for your return on investment, the IRR, is going to be lower than what it actually was previously in the deal. So
we could do this infinitely, right? It's compounding, but there I had to raise how much we raised in order to make those payments, and we still won't be at 8, right? We're getting closer now, but again, we had to raise the amount we had to raise, which then makes the pref larger. So it's just a downward spiral. But as you can see, we went from a pretty good return of 12.8 IRR, and we're way down to 9.2. I mean, it's a
drastic difference. So yeah, like I said, you have the cash flows now, but you're not seeing the return that you were hoping you were going to see.
Right. This is a huge deal. I mean, if you have cash flows that are this below the pref, I mean, if you're close and you just, you kick out a 50 grand extra here or there or something like that, it's not going to move the IRR by over 350 bips. But, if you're not familiar with underwriting and these types of benchmark returns, 300 basis points or 3% change in IRR is a huge difference.
Yeah. And we're not saying that this is what's happening in all of these deals that some sponsors might be doing. Like we talked about earlier, we're just kind of pumping the numbers up to really just drive home the differences it can make. I mean, I'm not saying any sponsors, making a deal, 300 bips less every time. I mean, some might be, but basically just to show you how it can affect the deal. So don't think that these numbers are the Bible or anything crazy like that. This is just to show the differences.
Right. So let's get out of this situation.
Sure, yeah, let's back out of that. So I think that was a great example of, you can raise those funds, but it's going to come at a cost, basically, and everyone might be happy with the years 1 through 5. So if you're a cash flow investor, yeah, that's a great, you're still, hitting a decent return. It might not be, a home run at year 5, but you still have, your expected cash flow. So there's an investor that's tailored to. So yeah, there's always a pro to that.
Okay, so let's dive into another scenario. What do we want to go over?
So let's see, we went through a scenario. Our base is what? A 8% pref with a 2% asset management fee and then the promote. So I guess, could we do maybe a hurdle to see the differences where a hurdle would come in on a sale?
Okay. So let's knock this price down. And now we're at a 16 IRR.
Yep.
So what this means, let's say, for example, we have a 13% look back or 13% IRR hurdle, where after a 13%, the GP and LP will split the profits 50-50. I don't personally have this built into my model because we haven't done a deal where this is something that we were advertising. But the way we would break this down is I actually have to unfold all these monthly calculations and go to, for example, year 5, where here would be your typical split here. You'd get 16% based on these project level returns, 5.6 million of proceeds coming out of the deal. First, we have to return the $3.2 million that was raised, and then we have to hit the pref, and then we can split it up to 15, or up to 13 rather, and then over that we can go 50-50. So this would be kind of tough to build by hand, but I mean, we can try to do that quickly, but what we'll do is we'll go like this. So copy all of these assumptions that will be the same, and the only thing that will change is actually the sale. So I'm going to take this formula, copy it over, and remove the sale price, which is going to be this number, this number. So that's just the cash flows. And then we need to get first to a 15 IRR. So what we'll do is we'll take the project level sale proceeds minus the capital invested. This is how much we have first to distribute based on a 70-30, right?
Yes.
So what we'll do is we'll take, let me know if I'm doing this right. I mean, by hand, I'm not so great at this. So we have 70% of the cash flow going here, and if that is added here, we should end up at the same number. There we go, IRR. So there's our 16. Okay.
Perfect.
But now what we'll do is we'll take this, and rather than just giving it all away, we'll give it up only up to 15%. So I think the best way to do that would be, gosh, I'm trying to think how to do this. Put me on the spot here.
You can always just pivot if you want to as well.
Yeah.
Okay, we'll just nix that part. It's not a big deal.
Okay. Yeah, I mean, I built it before by hand, but it's not easy.
Yeah, I didn't realize you didn't have it. That's fine. It's not a big deal.
Okay.
All right, so since we're basically at a part where we're cutting, where else do we want to go with this?
So we went over the pref, no pref.
We took out asset management.
We did asset management. We talked about that. Let's see what else there is.
We talked about kind of like cash outlay for as far as being in the raising more funds. We did that last bit on kind of co-investing, but I don't really think that affects the model at all. So
what if we did? So a good one would be to talk about the dual tranche structure.
Yeah.
That everybody is doing right now. It's pretty interesting. So let's see. Let's just clean this up. So back to the yearly look. Okay. So let's look at it this way. Okay, perfect. And then we will increase the price. Okay, I like this. Okay, cool. So, all right. So let's run through the dual tranche structure. Do you want to intro it, or?
No, I think, yeah.
I'll just intro it.
Just say so. How about we just say we want to tackle that and just go for it.
Okay.
Yeah.
All right. So the next thing we'll talk about is the dual tranche syndication structure. And this is where there are multiple classes of investor, typically a class A, which is paid a 10% return and no upside in the deal, meaning they receive 10% annualized returns, either paid monthly or quarterly, and they're preferred in the cash flow distribution to the Class B investors. Class B investors typically just have a traditional structure, let's say an 8% pref with the 70-30 split, still asset management fees. So it's similar for them, but they get a little more juice because the 10% preferred investors don't get any of the upside, so the Class B investors get more of the upside for themselves. So this structure usually results in higher total returns or a higher IRR for the Class B investors, but a lower cash flow because typically that 10% that the A shares get pull cash flow away from the Class B shares. So we'll run through a scenario now and just show that. So here's a deal where you have pretty decent return of 12.8%. But like we talked about earlier, that might be too low to really entice investors. So what we may want to do is break this deal out and offer the cash flow investors the opportunity to get a more secure stream of 10% payments. And the reason why I say it's more secure is because there will be a nice tranche of equity subordinate to that piece, whereby increasing their coverage ratio. So we talked earlier about debt service coverage ratio. Well, in this scenario, if you're in the A share and you're getting paid a 10% preferred return, you first are owed that 10% before all those Class B shares get any return. So that's why you're in a more secured position. And we can actually show that coverage ratio as well. But first, so what I'll do here is I will rename this to preferred equity, A shares or something like that, and just turn this on, and we're paying at 10%, and there's no amortization because we just have an IO period of 5 years. So basically these are just interest only, 10% payments, and at the end of the investment, those investors will get their original capital back, and that's it. So let's see how this affects the deal. So the Class B members who were getting a 12.8% return are now getting a 14. So it went up, not a whole ton, but it just varies based on the deal and also how much leverage you employ, meaning how much of the preferred equity you put in. So here we have $1 million of preferred versus 2.3 million of the Class B. And so what you could do to further squeeze the returns to get more for the Class B IRR, you would just increase the leverage. Now it's 1.5 versus 1.79, and now you're up to 15. So now the deal looks pretty good. The only downside is that 10% took a lot of cash flows away from the common equity. They're only receiving a 5% average cash flow. So, but for investors that really are focused on total return and are comfortable about the long-term prospects of a deal, this is a great strategy. And I actually really like it. People may talk bad about it and say, oh, it's just a structure for GPs to push the returns on thin deals. But I'd actually argue that it is actually a more appropriate and efficient capital structure, which gets two different types of investors what they want.
Yeah, and that's kind of what the point I wanted to drive home was, is conceptually, you're really just basically splitting up this deal, and instead of advertising a deal to a one-size-fits-all sponsor, you're now taking two different types of, or not sponsors, but investor. You're taking two different types of investors, where you have one on the one hand, which we've spoken about dozens of times today, where you have someone who just wants cash flows day one, so that would be your A class, and then on the other hand, you have the B class, who is more actually targeted towards the IRR, because they are looking at not necessarily needing that paycheck years 1 through 4, but as long as the total deal is netting them a good return, then they're happy. So you're kind of, like Rob said, splitting this up. And as you saw earlier, you had, by instilling that 10% pref, you jumped from, I think it was 12 and change up to 14% IRR for the B share investors. So that to them is more enticing, because now they are getting their higher return that they're looking for. And then on the A share side, they're getting that 10% every year, no matter what. And they're obviously happy, because it's just a different type of investment that they want. It's a different type of vehicle that they're looking to get returns on. So it's just two different completely types of basically profiles for an investor that you're tailoring to. And to be able to kind of offer that on both sides is advantageous in certain cases, depending on the deal, obviously, to all three parties, the A, B, and the sponsor. So yeah, it's definitely has some value to it, and you see it a little bit more now. Like you spoke, Rob, maybe some sponsors are doing it with ill intentions to maybe pump up the IRR for the B share investors, but really at the core of it, it should be just to be able to belay a more tailored investment opportunity to whoever you have as in your investor base. So yeah, I agree. There is a lot of value to be had with that, regardless of who you are as a sponsor, I guess.
Right. And for investors that are investing in these deals on the B side, I think it's important to recognize the leverage that's being employed to achieve those returns.
Absolutely.
So you shouldn't base these returns or compare them to a deal that doesn't have this structure, because they're not comparable. One is taking on more leverage via the Class A shares and one is not. So you should demand a higher return. So it's an interesting game, because on the one hand, you could buy a deal with lower returns, optimize the structure this way, and now you've got the same returns that a good deal has, and investors will buy it. But investors should be discerning and realize, well, this IRR is achieved through leverage, not necessarily through a better deal. And so they should also recognize that that's a higher risk. What I will caveat that with is the leverage employed from the Class A shares is soft leverage. This leverage isn't going to foreclose on you. It doesn't have default remedies or different control rights. So it's actually very favorable leverage, and I'm in favor of it. But just recognize that it is still economic leverage, and you can see when the IO period runs out, like it always does, it doesn't just drop from 8 to 6. Now it drops from
Plummets.
8 to 1.6. And that's simply because you're in a very levered position. So if we dive over to the pro forma, you can see same situation. Our debt is at a 1.3 cover on a T12 basis, underwritten basis. We're at a 1.24, so we're right there in line. And then if you look at it, the total interest coverage ratio, including the A shares, so the A shares are owed that 157 per year. We've got to make our debt service, and this is actually interest only, right? So with interest only payments on both the debt and the pref, we're only at a 1.23. So that is, I wouldn't say that's razor thin, but it's tough, right? And then you can see once we start actually amortizing the senior loan, we're at a 1.09.
Barely keeping afloat. Yep.
Exactly. So that is something to be really aware of. And even worse for investors, something they may not have a chance to really see on the surface, because all they see is, the great cash flows from the paid out pref. So they see, higher return, and I'm going to get a 7% pref, and you can see the pref being hit every year on the pro forma. You say, deal checks out. Well, you should actually uncover what it really looks like without any of that engineering.
Yeah, absolutely. And just one more quick synopsis here, basically talking about risk adjustment with these. So if you're comparing a B-class investor to just a typical deal where there is no dual tranche and you just have, a regular pref and that same returns, you would see that 15 IRR and be on a same deal with those two. You would want to not be a B share investor because of that risk, like you talked about. You see in years 4 and 5 on this sheet, and then on the other sheet, you saw the debt service cover ratio, or the ICR, the interest cover ratio, just plummet. Both of them just plummet, and that's because you have to pay that A share investor first, and if you can't do that, you're not going to get money. So that's the risk right there. So if you don't have a home run deal like Rob talked about, it is a lot more risk to be able to step into a deal as a B-class investor. And the upside is obviously the upside, and that's why you're getting the upside. But you need to make sure that the deal you're getting into as a B-class is basically just more secure in a deal. And if you're going to, basically look at a deal with, say, a 15% IRR and assume it's a great deal, and you look at one with a B share with the same 15% IRR, it might not be as great because, you're not guaranteed the same thing. So you need to, really make sure that the risk is in line with the return you're getting. Even if the numbers are the same, it's not always the same as you can see in the kind of year by year basis here. So
exactly. Yeah. So I think just throwing some numbers on it, if we like a 15% IRR net of fees deal in the traditional structure, then as an investor, we may want to demand a 17.
Yeah, and this is, we're talking, say, the same exact building, everything. We're just
the
talking
same,
about
it's just the
same building, same deal. Well, not same deal, but we're changing the same business plan to now include a dual tranche versus the regular method where you just have a single tranche. So yeah, so 15, 17, sure. Yeah, that's probably about right.
Something like that.
Bump it up a couple points. It kind of makes it a little riskier as a B share investor, but you also get a higher return if it works out. So, I mean, that's pretty much a good trade-off, basically.
Right. And with all these different structures and different financing assumptions, more leverage, less leverage on the debt side, things can get complicated and hard to compare apples to apples. And so something that we've been very focused on, and especially focused on lately, is unlevered IRR. And so that would be looking at and here is the metric up here. That would be a calculation of the IRR of the deal with no debt involved. So that would be, you bought the deal all cash, you collected essentially NOI because you don't have debt service, and then at the end you sold it and you got your money back, and that's the unlevered IRR. And then when you use leverage, you lever up to a project IRR, and then once you take out the GP's take, you get to the LP. And this delta is not usually this big, but
these are just the numbers we're playing with today, basically.
Yeah.
Yep.
And this project IRR factors in, it counts the pref equity, the A shares, as debt. So basically
it's looking a little funky.
Yeah, it's a little off here, but basically this unlevered IRR is true and true, and you can always rely on an unlevered IRR to give you a good basis of understanding of how a deal actually performs with that before you lay on all of the complexity. So for us, a good unlevered IRR can be anywhere from 9 to 13. 13 is a tremendous unlevered IRR.
Yeah, that would be incredible. And yeah, that's, I mean, not only from a sponsor side, but something as a limited partner you should be looking at too, is that unlevered, because, kind of like you said, eliminating all of those deal structures and kind of getting those weeds out of the way and just seeing it at its core, that unlevered is really just the project in and of itself. So before you sign on debt, before you raise and do all these tricky dual tranches and all this, kind of other fancy stuff, quote unquote, you can kind of see at its core what this property is going to do through 5 years. And that can help you kind of assess the risk as well. So yeah, on both sides, everyone should be addressing that, definitely.
Yeah, and then I recently put out an article about the dual tranche, and one of my other epiphanies that I had there was the opposite of the epiphany we had here about the fact that the GP's cut of the profits upon sale isn't affected based on the pre-raised strategy. In this dual tranche, the GP is likely to make less money, because if they're promoting the B shares on a 7% pref or an 8% pref, I mean, look what happened to these cash flows, right? They're at 5% now on average. And so if you look at the GP's cut, they will never see a promote. So they're taking on less, they're accepting less compensation. And then upon sale, they're actually going to receive less compensation as well, because they're going to have to catch up that pref. So we've also seen sponsors reduce the pref offered to Class B, which is interesting because it's almost paradoxical, because like we said earlier, you brought up the idea, the higher risk a deal, or the more involved it is, the higher the pref, the higher the promote should be. But in this situation, we're seeing a higher risk deal within a lower pref, right? So it kind of is an interesting,
It's fun to play these numbers. I mean, like you said, by adding that dual tranche for the sponsor, you would see, like you say now on this deal specifically, and maybe, it obviously varies, but you're seeing basically the A share investor takes away all of your month or your yearly cash flow promote. And then the B side investor takes away your sales promote, at least a chunk of it, right? So that I think is part of the reason why some people don't prefer this dual tranche system, maybe, is because it might seem to them that they're just seeing a sponsor make a deal out of nothing, and then they're okay with a smaller cut. They just want a deal type of thing. They just want to keep moving along. So, I mean, that's, I guess, where that kind of hesitation comes from. But as long as you have a good deal, all of these numbers still could be in line. Maybe they still don't get paid as much, the sponsor, but it still is a home run for everyone involved. So that's really the takeaways there, is that this system can definitely be structured properly to benefit everyone, but it doesn't apply to every deal, basically. It just can't. I mean, it's not a way to just make a deal out of nothing. It's not,
Right, and that's what you want to look. Is this deal being optimized, or is it being engineered?
Right.
It looks like my laptop's going to die. So let's show one more interesting example where let's say we did find a home run deal, or I'm buying from my uncle and he's giving me a great deal. We can buy this deal for $9 million, right? I kind of spoiled it, but let's quickly turn off the pref. And so this is now traditional structure, as you can see here summarized. Deal's a 22% IRR and a 13.6 unlevered. So we talked about this is above the high end. This is a fantastic deal.
Before that 13%, yeah, you can't get much better. I'm
exactly.
Sure. Yep.
And you can see here, on average, the cash flows are higher than 10. So by offering the 10% to the A shares, you'd actually be achieving positive leverage to an extent. So here, in the years where you have interest only, the cash flows on a project basis are higher than 10. So when you actually pay out the 10, you're creating positive leverage for the B shares, and you'll see these cash flows in years 1 through 3 increase. So let's look at it now. So you can see they increased just slightly because it was just a small delta, but you can see now we're up to 13, 13.8. This is tremendous returns. And then these are penalized because now we're employing negative leverage, right? The leverage we're using is costing higher than the return behind it, but the IRR just is a rocket.
Right.
So, we're looking for these deals just like everyone else, but we would definitely consider, it's almost a no-brainer on a deal like this where you have higher project cash flows than 10%, then it's a really interesting strategy.
Well, I'm glad you brought up this point too, because we kind of showed basically in years 1 through 3 on this model, we had above the 10% pref, which was what we were advertising to the A-class investors. So that was increasing it when we set up the dual tranche now to 11s and 13s, et cetera, instead of the 10s. And then years 4 and 5s actually lowered from, the high 9s to the little bit lower 9s. So in essence, you can kind of just picture it in a way that you're basically magnifying in one direction, whichever way it is set up in one direction, which basically how that's set up. So basically, if you had say 10% in this case, and your pref was 10, and your cash flows were below the 10, then you're going to magnify it even worse, and they're going to get even lower. But if you have above the 10, then they're going to get higher, like you see here. So that's kind of an interesting way to see it too, kind of played out. And then obviously for the B share investor, we have highlighted in the cell 30.5% IRR. So that gets, blown out of the water, because on this good deal, you kind of have some investors basically not playing in the upside, and they're just playing in the cash flows for the 10%. So you see a huge advantage there. So yeah, very interesting to get into it.
Very interesting. Sure. And what's interesting is when deals are juicy like this, sponsors are content and probably don't need to employ this structure, and they'll say, well, the deal makes sense. Everyone's going to make a lot of money. No big deal. But now that the returns are tight, late cycle, competitive market, now we're employing this dual tranche structure, and where we actually have negative leverage, right? So it's kind of counterintuitive, but it's interesting to see that if you did do this today, if you had a deal like this and you did it today, what would the A shares say? If they knew the B shares were getting this return, would they still be piling into this A position that's safe and secure? I think, because what's happening today is with these dual tranches, the A's are being piled into. Investors love this 10%, they love the protection, and they love the yield. Where else can you get 10% with tax benefits, right? So, however, if you had a juicy deal like this, would they still be piling into that A for that 10% with no upside when they see, hey, I could take risk, I'll get 11%.
Yeah, this is all theory, obviously, folks. If you have a deal unlevered at 13.5% IRR, you could probably, make a pretty good bet that it's not going to, completely, fold under you. So to only sit on the sidelines, quote unquote, and just take the 10 instead of playing in the upside, it would be interesting to meet those investors to talk them through that. Obviously, if you're a cash flow investor, deal with a 13% unlevered IRR, you're probably going to get cash flows no matter what. So yeah, so exactly. It would, like you said, interesting to talk to that A-class investor on a deal this crazy good. But yeah, it's a good thought exercise for sure to be able to think about the pros and cons for everybody involved. Yeah, and so I think battery limitations will wrap up quick, but I will quickly advertise us and just say that we are heavily pursuing a deal right now that I believe is a 12.8% unlevered IRR for interesting reasons that I won't go into 100%, but unlevered IRR isn't always king, but you can lead into deals with generously high unlevered IRRs if the financing on the deal is penalizing the total returns. So that's an interesting sneak peek. Maybe we'll discuss something like that another time. But yeah, there's an interesting way to get higher, pursue deals with higher unlevered IRRs when you're assuming debt that is unfavorable, leading to a discount. Yeah, excellent. Well, maybe in the debt section of this series, we'll get into that or something good like that. But yeah, A lot of fun today, Rob. I think is probably a good stop point. Obviously, your battery's running out, so we'll call it good for today. Hopefully, you guys got a lot out of this. I think we really hopefully told a story with the model. It was pretty fun to be able to change some numbers and see kind of the yearly cash outlays and all that good stuff. And if you have questions, you can definitely reach out to either me or Rob. I'll have all that good stuff in the show notes for you to be able to do that. And just a quick plug for Rob, he's at Lone Star Cap Group, pretty much how it sounds, phonetically.com. Reach out to Rob Beardsley and then myself at Longview Acquisitions. And yeah, we'll love to help you out. Please let us know your comments, concerns, questions. If you have any more questions, I'm sure there's plenty of more we could talk about this specifically even, but we can only do so much in one show. So yeah, thank you so much for joining us today. We'll see you next time.